All right, so we're starting our management accounting techniques. This paper, we used to call it management accounting costing in level 3. Now we called it management accounting techniques with the AQA 2022. Now you can see this one. It says like the exam will be start from September 2022. But as I said, before you can do the exam, you need to make sure you register with the AQA 2022. If you have AQA 16 registration, you will not be able to do this exam unless you register with the new syllabus. Now, the new registration, all of us, we know it's not every year. So you have to pay for the registration next 4 to 5 years. So when you pay the registration, you pay actually for the next 4 to 5 years. So next 4 to 5 years, you don't have to pay any registration. So you do your level 3, 4 with this registration, you don't have to pay extra. All right, let's have a look at our content and quickly look at this content, what we have here. So we have 12 chapters to complete from this book. We have Introduction to Management Accounting. We have a cost classification. Introduction to Management Accounting. We don't have anything else here. It's just very basic. What is management accounting? So we need to know this thing from there. Then we have a cost classification and the cost behavior. From this chapter, you're going to see the different type of cost. For example, what is variable cost? What is fixed cost? What is a step cost? So how this cost work? We're going to see from that chapters. Then we have a material and labor cost. From this chapter, we're going to see how we calculate the material and the valuation of the material. For example, using some techniques, FIFO, first in, first out, FIFO, the average method. And also we're going to see like how to control the inventory. For example, the EOQ models and some other costing method we're going to see from there. On the labor cost, we're going to see how to calculate the basic rate with the overtime and overtime premium, and how we identify which one is the direct cost and which one is indirect cost. So you're going to see all of this from chapter number 3. Chapter number 4 is allocation and apportionment. Here we're going to see how to allocate the cost and how to apportion the cost. Normally, any sort of organization, they have a two center. One is production center and one is service center. So the production center, they make the product, and the service center, actually they provide the services. So how we transfer the cost that is relevant to the service cost center, we move to the production cost center, and how we allocate it, we're going to see on this chapter. Then we have absorption costing. This is one of the method how we allocate the cost into the cost unit. For example, when we have a cost, for example, variable cost, fixed cost, when we added all the cost, we have some method to follow in order to identify how much is the total cost. So we have an absorption costing method, we have a marginal costing method, we have a activity-based costing method. All this costing method we're going to see from this course, but on chapter number 5, we're going to see absorption costing, how does it work. Then we have a job batch and service costing. So here, what happens if we make so many units at the same time, or we do any specific contract? For example, if we make a pen, so we may make a lot of pen at the same time. So thousands pen in one unit, in one box, or we can make a lot at the same time. That is called the batch costing. And the job costing is all about like when you have a specific job. For example, if we get a contract to make a house, or if we get a contract to make a road, so this sort of work is a job. Then have a standard costing and budgeting. So here we're going to see how to find the standard costing of a product. The standard costing is the cost supposed to be of a product based on all the relevant cost we have, and obviously like how we make the budgeting, we're going to see from there. Now we have a different sort of budgeting. We have a cash budget, we have a rolling budget, we have an incremental budget. So all these things we're going to see from this chapter. Then you have a variance analysis. A variance analysis, basically, this is the one. It's very common in the exam. So in variance analysis, we're going to see the difference between the budget and the actual. For example, my plan was I'm going to spend £10 for the material, and actually I spent £12. So my plan was 10, but I actually spent 12. The difference is 2. So the variance is 2. So variance analysis is basically the difference between the budgeted cost and the actual cost. Then you have a marginal costing. We're going to see how we calculate the unit cost according to the marginal costing. These two are very common, the marginal costing and the absorption costing. Only the difference is how we treat the fixed cost. In absorption costing, we treat the fixed cost as a product cost. That means inside of the product, we see the fixed cost. But on the other hand, on the marginal costing, we don't see that. So marginal costing only consider the variable cost, and fixed cost is treated as a period cost. So we're going to see all of this from these chapters. Then we have a short-term decision making. Short-term decision making, sometimes we know this one as a CVP analysis, cost, volume, profit. On the cost, volume, profit, we will see normally our break-even point, BEP, then we see our target profit, then margin of safety. All of these things we're going to see from this chapter. Then we have chapter number 11. Chapter number 11, we have a cash management. Here we're going to look at some ratio analysis. For example, how to calculate the profitability ratio, how to calculate the liquidity ratio. All of the ratio analysis we're going to look at from this chapter. Then finally, we have some spreadsheet. Now, a spreadsheet is basically showing some formula. For example, VLOOKUP, pivot table, data validation, if formula, goal seek. This sort of formula we're going to learn from that chapter, so that in the exam, if the question asks you anything, we can do that. And obviously, as I said, we maybe do 7 weeks to complete these courses, and hopefully after that we'll be ready for our exam. It depends how many chapters we can do every week, but if the chapter is small, we try to do 2 and 3 chapters. Maybe we'll try to do today 3 chapters, chapter 1, 2, and 3, because chapter 1 we don't have anything. It's just a little bit explanation what is management accounting, and after that we can do chapter 2 and 3. Let's look at the exam criteria. The exam duration will be 2.5 hours for exam, and it will be computer based. So we can see if the exam is computer based, that means we'll get the result normally in 30 minutes. After the exam, within 30 minutes, we'll get the result. And duration of the assessment, 2.5 hours. And we're going to see how many questions will be in the exam. Let's have a look. So you can see here, this is the detail. So we have here 6 questions to do. So 70% we have to score. Within 2.5 hours, we have to score 70% by answering 6 tasks. So you can see what task will be in the exam. The task 1 will be costing techniques, and this will be for 24 marks. Task 2 will be the attributing cost, 24 marks. Question number 3 will be short-term decision making, 24 marks. Question number 4 will be the budgeting and the cash management, 16 marks. Then we have some more question. 2 more question we have. Question number 5 will be preparation of the budget, 16 marks, and question number 6 will be the budget and the deviation, so it will give us another 16 marks. So all this thing will be in the exam, and actually we know what chapter will be relevant for that. For example, preparation of the budget, we can see the question will be cash budget, inventory, and other budget. The relevant area will be the chapter number 7, chapter number 11, chapter number 12. So this 3 chapter will be relevant for this question. So actually this will give us the idea what chapter is relevant for what question. And of course, we will do all the chapters anyway, but before the exam, we need to know which question we are very good at. For example, if we think like my Excel is not very good, so we know like chapter number 5 and 6 will be a link with Excel, and other question 1 to 4 is not Excel. So we need to know like what question will come from which area is very important, so that we can make our plan and we can make ourselves more ready for the exam. All right, so let's move on to the chapter number 1. Let's have a look what we have here. Chapter number 1 is Introduction to Management Accounting. Now let's talk about a little bit about the management accounting. What is management accounting and why it is important? Now, some of us, we study accounting and we think accounting is one thing, but actually accounting is a big area. There's a lot of things you can choose from accounting. Now, in future, some people decide to be just a management accounting. For example, if you know, like after AAT, for example, you decided to do your CIMA. Now, the CIMA is all about the chartered cost management account. So some people, they said like, okay, I like to work in the top level management. So some people do CIMA. and they only work on the management side. And some people, they decide to do ACCA and ICAW or ACA, and they want to be a financial accountant. So the difference between the financial accounting and the management accounting is management accounting is used for the internal purpose. So they make the planning and they help to take the decision. For example, let's say if you're planning to sell a product in the company, so you do the market research and you decide like, I want to launch this product in the market and I want to see how much I can sell. So basically this plan, this budget made by the management accountant. So management accountant prepared the financial statement, prepared the cash budget, saying like you can sell this number of unit. If you can sell 10,000 unit, this will be your cost, this will be your profit. So they'll give you all the information. So you can have a picture on your eyes, like you can see like, okay, if I can sell 5,000 unit, this is my profit. If I can sell 10,000 unit, this is my profit. If I can sell 15,000 unit, this is my profit. So management accountant help you to the directors, to the owners to take the decision. On the other hand, the financial accountant who do ACCA or ACA, they don't help the management. They work on the financial side. Now, their job is mainly the reporting. Reporting means to whom? Reporting the external body. For example, the HMRC, the company house. So they prepare the financial statement and they submit to the company house, they submit to the HMRC for the tax purpose. So when you look at like some accountancy firm on the street, they said like chartered accountant. That means they are the financial accountant. Remember that they're not management accountant, they're financial accountant. So financial accounts is available to see by everyone. For example, if I like to see how much profit or how much is the asset of Tesco or Sainsbury or any other company, I like to see, and I can go to the company house, anyone can log in and anyone can see. But the management accountant or management account is only for the internal purpose. So no one can see it. Remember that management accounts only see by the management. So they don't publish it anywhere. No one knows it, what is on the management accounts, except like the people who work inside of the management or the directors. But the financial accounts is only for the reporting purpose for the outsider. So this is prepared on the reason to make a report to someone. This is the main difference of the management accounting and the financial accounting. And the management accountant, their job is to make the planning, make the budgeting so that they can help to take the decision to the management. All right, let's move on to have a look to what we have on the chapter overview. Let's have a look at this chapter overview. In the chapter overview, you can see here is the management accounting main areas. So we have a decision making. As I said, like it will help you to take the decision. Now we have a short-term decision and long-term decision. Now the short-term decision, normally, if anything, any project you like to invest, and if you think the return will be within a year, or with or less than 5 years. Normally, like it depends on the company, but normally it is definitely less than 5 years. For example, if you want to invest in a company and if you like to get the return within 5 years, so normally you look at the short-term decision making, like I want to stay short-term in the market by analyzing, for example, the break-even or target profit or the margin of safety. And on the other hand, we have a long-term decision making. So long-term decision making, you want to invest in a project and you want to invest for a long term, for example, more than 5 years. Normally, the technique we use, we called it, for example, payback period, NPV analysis, that is net present value. And we also see the IRR, that is internal rate of return. So this sort of thing normally look at for the long-term decision making. In detail, we're going to see later on how to calculate all the formulas, all of this. Then we have a costing. So costing is one of the main part that management accountants do. So they find it out how much is the variable cost, how much is the fixed cost, and they calculate all the cost to find it out how much is the total cost. And so that the production manager knows like how much is the cost for each product, and the sales team, the director, they can set up the selling price based on the cost. So cost of producing a unit or providing a services for valuing the inventory. Now, this is another responsibility of management accountant to value the inventories. Now, inventories, we already know what is inventory. Inventory means stock. Inventories means stocks. Inventories means stock. Sometimes you call it inventory, sometimes you call it the stock. And this cover under IAS 2. IAS 2, International Accounting Standard 2. So I is to explain how to value the inventory. Now, normally the inventory will be valued lower of cost and the net realizable value, but for this paper, we're not going to see that. Here, we're going to see what is the valuation technique we have. So we're going to look at FIFO, that is first in, first out, and we're going to see AFCO. AFCO represent average. So you're going to see these two methods. There is another method we used to use called LIFO, last in, first out, but nowadays we don't use it anymore. Some country, they ban LIFO. They said you cannot use LIFO anymore. Then you have a planning. This is also responsibility of the management accountant. So they do the planning. So they do the planning, budgeting, and forecasting. So forecasting means making a plan for future. We call it forecasting. Then you have a control. Control is very important. So if we make a plan, if we make a budget, we need to make sure we are going with the plan. So we need to have a proper control. If we don't have a proper control, we'll not be able to have a like a track, like we are following our budget. So it's very much important, like have a proper control on the budget. So the way we can do to make a comparison, budget and actual. So we see how much was the plan and how much we are actually paying. So the difference between these two, we called it variance analysis. Variance analysis. So the difference between the budget and the actual, we called it variance analysis. All this thing we are discussing now, we're going to see in detail later on. So obviously nothing to worry. It's the first chapter. So we're just having a brief what it is. All right, so let's move on. In the chapter, let's have a look what we have. And now we have a few things here. So as we said, the management accountant, their first responsibility is to do the planning. Now planning means like do some analysis for the future. So if someone said what is planning, so you are basically doing some budget, doing some analysis for the future, and we call it planning. And based on the planning, we have to make some control. The way we can do the control with variance analysis. So once plan have been made, the company must ensure that they are being followed and assess any inefficiencies in the business. Inefficiency or discrepancy means like, am I going with the plan or not? Then we have a decision making. Decision making is very important because based on these two, the planning and the control, obviously the decision will be more effective. So there are many decision managers may have to make, such as what should we produce, how should we finance the business, and is the project is worthwhile. Now all these things answered by the management accounting. For example, how should we finance the business? Now where the money coming from? Now we already know if we want to do a business, we need the capital. We need capital. And if we break the capital, inside of the capital, there is two things. One is equity and one is debt. One is equity and one is debt. Equity means the money invested by the owner. Money invested by the owner. And the debt means the money I borrowed. So borrowed money. Now, the borrowed money can be from the bank, can be from friends and family, could be from anywhere. So you can borrow the money from anywhere. So when I need to start a business, I need a capital, and this capital can be all of my money. So it is possible I invested all my savings, or I sell a asset, or I sell a land, and I invested all my money to the business. Or maybe like I borrow some money, or maybe it is a mix. So I have some my own money and I have some borrowed money. So together we call it capital. So if I break the capital, there will be two things. One is the equity and one is the debt. So equity means is all my money, 100% belongs to me, and the debt is belongs to the money from the third party. So I borrow this money from someone. And is this is a product worthwhile? That means like should I go for the project or not? So it depends what type of return I'm looking for. For example, let's say if I calculate my IRR, that is internal rate of return, or the payback period, that will tell us like how quickly I'm going to get this return back. For example, let's say you have a plan. If I don't get my return back within 5 years, I'm not going to invest in this company. So when you calculate the payback period, you'll see if it is more than 5 years. So you decide like, I'm not going to invest in this company because I'm not going to get my return within 5 years. So for that reason, you said, I'm not going to invest. So for every single area that we're going to take a decision, there is some criteria that has to be fulfilled, and that has been done by the management accountant. All right, let's have a look. What else we have? We can see we have one activity. Let's quickly have a look at this one. It says, the management accountant may provide information for management on which of the following. So they said management accountant provide information for management on which of the following. So which type of information you can get from the management accountant? So let's start with that. The first one is that cost of goods and the service. Do you think this sort of information we can get from the management? The answer is yes. So this sort of information, cost of goods and the services, we can get from the management. The answer is yes. Actual cost compare with the expected cost. So how much was the budget and how much was the actual? Can I get this information from the management? The answer is yes, I can get this information from the management. Then we have expected profit and production plan. So can I calculate how much will be the expected profit and how many units I'm going to produce? Yes, from my budget, I can get this one. So I can see how many units I'm going to produce, and based on that, how much will be my profit. So actually, before I launch the product, I can see my expected profit. So this is also true. So all this information, it is possible I can get from the management. All right, let's move on to the next area. The next area we have here, revenue and the segment cost. Now, I'm sure like you know what is revenue. Revenue means sales. But this one, maybe some of us, we don't know, segmented cost. Let's little bit talk about that. Segmented cost. What is the segmented cost? It's a very important to understand that. Segmented cost is like separate the product to find out individual cost and the revenue. Now, for example, it is possible, I have a shop, for example, and I sell, for example, tea, and I sell also coffee. So I sell both. Now, for example, at the end of the year, I have a profit. Let's say I have a tea and I have a coffee, both. And at the end of the year, my profit is 20,000 pounds, for example. So I sell tea and coffee, and at the end of the year, my profit is 20,000. Now, if I say like, okay, my business is, if someone asks you, how is the business going? You said business is very good because I'm making a profit. Now, obviously, I will keep carry on this thing. I will keep selling tea and coffee both. But it is possible, maybe one of the product giving me a lot of profit, another one maybe not giving any profit at all. So for example, let's say my tea is giving 30,000 profit and my coffee is giving 10,000 loss. And together I end up with 20,000 profit. So that means if I make a segment, if I make a separate calculation, and if I see the segmented income and expense and the profit, so what will happen? I'll say like, oh, that means my tea is making 30,000 profit, but my coffee is making 10,000 loss. So in this case, if I decide I'm not going to sell the coffee anymore, so my profit will be go up by 30,000. Because of the 10,000 loss of the coffee, my profit is 20,000. So unless I make a segment, maybe I'll never know, like because of one product making a loss and I have a less profit. So it's very important to understand that. And for that reason, you have to make a segmented cost. We're going to see it later on. Then we have some few things here. We have a material cost. The material cost is a direct material. How much is basically we spend for the material. The direct labor cost and overhead. Now, this overhead could be direct and could be indirect. Let's try to understand what is the difference between the direct cost and the overhead. So for example, if I say this pen, so what is the direct cost in this pen? So if you look at this pen, what I can see in this pen, that is my direct cost. For example, I can see the plastic, I can tell 100-gram plastic in this pen. That means 100-gram plastic is my direct cost. I can see there is some ink inside. So ink is my direct cost. I can say like to make one pen, I need 10 minutes. That means this 10 minutes is my direct labor cost. But there is some other cost also that I cannot see. For example, how much heat and lighting I spend to make this pen. I don't know. How many electricity is there? I don't know. So for that reason, whatever I cannot say, for example, how much is the rented cost here? So I don't know. So if anything I cannot say directly or anything I cannot measure directly, this is called indirect cost or overhead. We're going to see it later on. Yes, all the segment cost and everything we're going to see it later on. Segment cost represent separate. That's correct. Yes. So we have this one cost unit and the cost card. The cost unit is basically the unit of product or service which cost can be attached, and the cost card is basically represent all the costs together. For example, if you look at the cost card, we can see the direct material, direct labor, and direct expense. And if we added all of this is the prime cost. So with the prime cost, you can see we have a production overhead and production cost. Then we have a non-production overhead, that is selling in admin and the administrative cost and the finance cost, and that gives us the total cost. So from the cost card, we're going to see all the cost we have. So the cost card will tell us how much is the total cost. All right, let's have a look something. Obviously, this sort of thing is only for the knowledge. You're not going to see this thing on the exam anyway. Okay, let's look at one example for the segmented cost. So here they are saying we have a two product. We have a C1 and C2. Two product we have C1 and C2. Sales revenue C1, C2 together we have a 270, the sales revenue, and the total cost together for the C1 and C2 is 260. So if you minus 260 from 270, we have a profit 10,000. So when we don't do the segment, we make all the product together. So my profit is 10,000. Now, if I make the segment where I like to see the profit separately, you can see here. So we have a CT1 and CT2, that's total. So I can see my CT1 makes me profit 20,000 and CT2 make me loss 10,000. And for that reason, the total profit is 10,000. So it's very important to understand. Now I understand my CT2 actually don't make any profit, actually is making a loss. That means if I decide to stop this one selling, so my profit will go up by 10,000, my profit will be 20,000. For that reason, you always have to look at the segmented. You have a different sort of product rather than making all this thing as a whole. That's why you have to make a segment. For example, if you look at the BMW car, even though it is one company, but you will see they have a different segment. For example, the department, they make the engine, the department, they make the body, the department, they make the glasses. So they have a different type of department, and one department sell to another department. For example, when the department who make the body of the car, they sell to the engine department sell to the maybe where they make the assemble. So they sell to each other. It is internal without making any profit. They try to sell it so that they can see like how much actually, you can see like what is the revenue from each department, what is the cost of each department. Otherwise, for example, if the market is not good, for example, if the sales department couldn't sell enough car, maybe all the blames will come to all the department. Now, for example, this is not the fault of the engine department. This is not the fault of the for the assembly department or the department who make the body. So this is not their fault if the car cannot be sold in the market. This is the responsibility of the sales department to the marketing and sell it. So for that reason, individual department have a different responsibility and accountability. And that's why we said the manager is not responsible for something that is beyond their control. So if manager is not liable for that thing, so he's not accountable for that as well. All right, let's move on to the next one. Next one we have here budget planning. So here we have ethics. So let's talk about a little bit the ethics. Ethics, we have done most of the paper. If you've done any paper before, you see the ethics. Ethics will be every paper. So 5 marks question, you're going to see 5 marks in the exam from ethics in any level 3 paper. So any paper you do, the same ethics you have to revise every time. So the 5 fundamental principle, this is very important. You need to know 5 fundamental principle. So the ethics have 5 fundamental principle and few threats to the objectivity. You need to know both of these. So let's talk about the first 5 fundamental principle. So the first 5 fundamental principle, let's start with integrity. Let's start with integrity. Integrity is all about honesty. So as an accountant, we have to be honest in our professional life, and we have to be transparent to the client. For example, if we have anything to tell, we have to make it open, and we have to be always aware if we have a, like, for example, any conflict of interest. So for example, if we have like same industry client, we have to tell the client, like, I have a client that's from the same industry. For example, let's say you have a client, you are an accountant, and Tesco is your client, and next day Sainsbury approached to you and said, like, I want to be your client as well. Now, if you like to offer the services to the Sainsbury, you need to tell the Tesco, like, oh, this is also coming to me and they're from the same industry. So I think, like, I need to tell you because it's a conflict of interest. Or for example, if a client come to you and said, like, how much you're going to charge for my business. Now, maybe you know you need to spend only 100 hours, but maybe like you charge for 150 hours. So it's not very accurate. So fundamental principle is you have to be always honest to your client. And then professional behavior. Professional behavior is all about, like, you have to be comply with relevant law and regulation, because if you don't follow it, then it will not only damage your personal reputation, it will damage the reputation of your institution. For example, let's say one teacher from the Oxford University, and he caught driving a car like with a high speed. Now, next day in the newspaper, it will not only tell his name, it only also mention, like, he is from the University of Oxford. Now, when you do something wrong, it will not only say, like, Mr. X and Y, he done something, money laundering or something, but it also mention he was an accountant. So it will not only damage your personal reputation, it will also damage your institutional reputation as well. So for that reason, you have to make sure anything we do that will disrespect our profession. And then you have a professional competence and due care. Professional competence and due care is all about, do I have enough experience? Do I have enough expertise? Do I have enough resources? Do I have enough capability or capacity to carry on the work? Can I provide the best services to my client? If the answer is yes, only that time I will accept the client. If the answer is no, I never accept the client. Remember that. So if I believe I don't have enough experience or enough ability or resources to give the best services to my client, I do not accept that client. I don't offer the services. So only we need to only we accept the clients when I can make sure I can provide the best services to the client. Then confidentiality. Confidentiality is all about, like, I need to keep my client information always in confidential manner, and I should not keep it unless like it is required for me, and we have to destroy it in a secure manner. Now, for example, if I have a client and I have a lot of confidential information access because I work with him or he's my client, so for no reason, I should discuss the confidential information with anyone unless unless it is like, or except it is authorized by law. In some situation, I'm allowed to discuss the client information with the third party. For example, when it is against the public threat. For example, if a client involved with money laundering, or if a client involved with destroying the environment. For example, if a client damaging the sea or damaging the environment, and maybe involved with money laundering. In some cases, I'm allowed to disclose the client information. For example, if there is a HMRC investigation, or for example, if there is a order from the court, in some circumstances, I'm allowed to disclose the client information. Otherwise, I'm not allowed. Then we have objectivity. Objectivity is all about I should not be biased in any situation. I should not be biased in any situation. That means in every situation, I have to be fair. Fair means like I will not give the advantage to someone because like of any sort of interest. For example, I will get some extra money, or maybe I know him as a family member, or he's a very powerful person. So for any reason, I should not be biased. I have to be always fair to everyone. So this is all about the fundamental principle of ethics. And for any reason, we should not compromise our fundamental principle of ethics. Now, there is a word that will help us to remember the 5 fundamental principles of ethics. And this word is called Dr. Pico, P-I-C-C-O. So Dr. Pico will help us to remember the 5 fundamental principles of ethics. So P for professional behavior, I for integrity, C for competence and due care, C for confidentiality, and O for objectivity. So if you remember this word, Dr. Pico, it will help us to remember the 5 fundamental principles of ethics. All right, so let's move to the next one. Let's have a look what we have. As I said in the first chapter, we don't have anything, not many questions, just the explanation. So we can move to our next chapter. All right, the next chapter we have cost classification and the cost behavior. So here we're going to see how many types of cost we have and how they behave. Let's look at our chapter overview, a little bit explain before we move to the in chapter detail. So we have cost behavior and we have types. The first one you can see fixed cost. Now the fixed cost is quite interesting. Fixed costs remain fixed. Fixed costs remain fixed in total, but fixed costs decrease per unit if the volume increase. What does that mean? For example, my rent for the building or for my production center is £10,000. So my rent is £10,000. So that means my rent is fixed anyway. £10,000 for the whole year, my rent is fixed anyway. Now, the fixed cost is fixed in total, but how many units I produce, based on that, fixed cost per unit will be either increase or decrease. For example, if I produce 5,000 units, for example, if I produce 5,000 units. So if I make 5,000 units on this production center and the rent is £10,000, so how much is the fixed cost per unit? So it will be £2. Now, if I can make more unit, for example, if I can make 10,000 unit, not 5,000. So how much will be the fixed cost per unit now? It will be £1 per unit. So what we understand from here, we understand if we can make more unit, then the fixed cost per unit will be reduced. So the simple explanation is fixed cost is fixed in total, but per unit it will be decreased if the number of unit is increased. So this is the story of the fixed cost. So we have, you can see here, total fixed cost constant regardless of the level of output. Per unit fixed cost increase in output. So this is the explanation of that. The next one, you have a variable cost. Remember that the variable cost is the remain constant per unit. If I make 1 unit, my cost is, for example, £1. If I make 2 units, my cost is £2. If I make 5 units, my cost is £5. If I make 10 units, the cost is £10. And if I don't make any unit, my cost is 0. So the variable cost is a vary in activity level. So if I make more unit, my cost will be more. If I don't make any unit, then my cost will be 0. But on the other hand, the fixed cost is like kind of always fixed. Even though if I don't make any unit, my fixed cost is still same. So I cannot tell like, okay, this year I didn't make any unit, I'm not gonna pay the rent, it's not gonna work. So I have to still pay the rent, even I make any unit or not. So it's very important to understand. So the fixed cost change with the unit, but not the variable cost change with the unit, but not the fixed cost. Okay, then we have a semi-variable cost. Semi-variable cost, sometimes you called it mixed cost. Mixed cost. The reason we called it mixed cost because we have a two type of cost included here. So we have a variable cost and also we have a fixed cost. So in the semi-variable cost, we have a both. We have a variable cost and also we have a fixed cost. Now, for example, if someone said like 10,000 is the total cost, and that means inside of the 10,000, I have a fixed cost and I have a variable cost. And if the question asks you, find it out, how much is the variable cost and how much is the fixed cost? What is the best way we can find it out? So we need to use a technique and we called it high-low method. We called it high-low method. We have a technique to find it out. We called it high-low method. And later on this chapter, we're going to see how to calculate the high-low method. But for the time being, we understand semi-variable cost means where there is a portion of fixed cost and portion of variable cost is together. If I want to give an example, sometimes we can say the phone line. So if you have a land phone, so there is some fixed cost for the broadband. So £18 you have to pay in the month anyway, even though you don't use the phone. But if you call or if you use internet, then it will be more than 18 based on your call, how many calls you make. But 18 pound is fixed. So this is something, the example of the semi-variable cost. So some costs are fixed and some costs are variable. Then the next one we have is step cost. Step cost is quite interesting. If step costs remain fixed up to a certain level, and after that jump to the another level having a same cost. So up to a certain period, the cost is fixed, and after that, it jump and increase. Now, what does that mean? That means, for example, let's say we have a classroom. And in this classroom, we can teach 50 students. And for 50 students, the teacher charge, for example, £200. So for one session, the teacher can teach maximum 50 students and he charged £200 for that. Now, for example, for any reason, if you have a 51 student, that means for 50 students, you have £200, and for one student, you still have to pay £200 because for one student, he need to carry on the same session. So when up to 50 students, the cost is fixed £200 up to a certain level. So 1 to 50. So from 1 to 50, it is fixed. But when it is more than 50, it will be jump to another 200 for the next 50. So here again, it will be, so 51 to 100, it will be here up to 200. So if you for one student, 5 students, it will have the same cost. So it is fixed up to a certain level. And after that, it will be increased with the same amount for another period or for another activity level. Now, of course, like it has happened normally when we have a supervisor. When you have a supervisor and they can look after, for example, a certain number of employees, they can look after 100 employees, they can look after 200 employees. And if the employee number is crossed, then they need another shift. So they will charge for another shift. So up to 100 employee, maybe the cost is £1,000. And for one employee, after 1,000, maybe another 1,000 cost. So it will be increased by step by step. So that's why the graphs for the step costs look like that. So it is fixed up to that, and after that increase fixed, then that increase fixed, that increase. So that's how it will go. After a certain period, it go up and up. All right, so let's have a look. What else we have? We have here fixed and variable costs. We know that this one. Then we have some different sort of cost is said like the production cost. Production cost is all about if the cost is relevant with the production. For example, material, for example, labor, overhead, and overhead can be direct, can be indirect. I give the example. If I can directly trace in the product, for example, the plastic, the ink, it is a direct cost. If I cannot directly, if I cannot directly trace the cost, we call it indirect overhead. For example, the overtime premium could be indirect overhead. So we have non-production overhead. This is not relevant to the production. For example, selling and distribution, admin, and the finance cost. For example, the cost we pay to the accountant, it is because of the business, but it is not directly relevant to the production. So for that reason, we called it non-production overhead. So admin, selling, and the finance, this sort of cost is non-production overhead cost. All right, so I think this is our chapter overview. Let's move on and have a look. So what else we have? We have some definition of the capital revenue expenditures. So I think it's not very difficult thing. So we have direct labor, direct. Let's quickly have a look at this one. Direct material that are incorporated into the finished product. Now, the meaning of the finished product is the product is ready to sell. Now, the product have a different stage. For example, we can have a like work in progress. The work in progress means the product is still on the process, it's not ready yet. We called it work in progress. Then we have an indirect material. Indirect material, we have material that are used in the production process but not incorporated into the product. Example, machine lubricant and spare parts. So this sort of thing we use during the production, but it is not actually like on the product. Then you have a direct labor, wages paid to the employee. Indirect labor, wages and salary for other staff, for example, supervisor, storekeeper, and maintenance. So they also get the salary. This is indirect labor, but they are not involved with the direct production. Direct production means who is actually making the product. Direct expense that are identifiable with each unit of products, such as patent, royalty, payable to the inventor of a new product or process. Indirect expense that are not spent on individual unit production, example, rent, electricity. So we know this thing already. Indirect expense means the expense we cannot trace on the product, and this one we have to pay not on the individual but because of the production. For example, rent, rates is all about the council tax. Sometimes some of us, we don't know what is the rates. Rates is like when you have a house, we pay council tax, but when you have a business, we pay business rate. Same story, same thing, we pay to the council, but from the house we pay council tax, and if we have a business, we pay business rates. Now there is two more words we can see here. The prime cost. Prime costs represent only the direct costs. All the direct costs together, we call them prime cost. So the direct cost means direct material, direct labor, and direct expense. So direct material, direct labor, and direct expense, all these three direct costs, we call it prime cost. Then the overhead is indirect material, indirect labor, and indirect expense. So all the indirect costs together, we called it overhead. So if someone said like we have a lot of overheads, we understand what does that mean, all the indirect costs. All right, let's move on. Then we have a cost behavior. We have some template, like some graphs we can see here, like how the fixed cost look like. If you have a look, the fixed cost. So this is my unit, that's my cost. So regardless how many unit I make, doesn't matter. You can see the fixed cost up to here is fixed. So that means my fixed cost is here. I need to pay, for example, 10,000 pounds anyway, regardless how many unit I make. So if I make, I don't make, doesn't matter. I need to pay the fixed cost here. This is the graph look like for the fixed cost. Then we have a graph for the fixed cost per unit. This one, like if I make more unit, then fixed cost per unit will go down. For example, if I make only this unit, you can see my cost is very high. If I make this number of unit, my cost is there. If I make this unit, my cost is there. If I make this number of unit, the cost is there. So that means more I'm making the unit, my cost is going more down. So more unit I'm making, fixed cost per unit going more down. All right, we have one example. Let's have a look at this one. So activity one, let's try everyone together. So we have still limited makes garden benches and in-car fixed cost 20,000 per year. Calculate the fixed cost per garden bench at the following output. So what happens if I make 1,000 unit, 10,000, 20,000, 100,000? My total cost is 20,000. So how much will be the fixed cost per garden bench if I make 1,000 unit for A, B, C, D? So 10, 20, and 100. So I'll give you 2 minutes. So make some workings and then we'll do it together. So let's take a 2 minute and see if you can do something. All right, let's have a look. So the first one is says how much will be the cost per garden if we make 1,000 unit. So my total cost is 20,000 pound. And what's happen if I make 1,000 unit? So cost per unit will be 20. Very good. How much will be for the B if I make 10,000 unit? So it will be £2. Very well done. Then the next one we have C. How much will be the cost per garden if I make 20,000 unit? Number C, it will be 1. Very well done. And how much will be the D if I make 10,000 unit? It will be 20 pence. Very well done. All right, so anyone have any question before we move to the next question? It's quite simple. Just need to divide to find it out how much is the cost per garden. All right, everyone happy with that? So let's move to the next one then. The next one we have here a few examples. So you'll move to the question straight away. So let's move over here. We have here activity 2, fixed cost and the variable cost. So how much is the fixed cost and how much is the variable cost? So an overhead cost 580,000 is made up of a fixed and variable element. So overhead cost 580,000 is made up of fixed and the variable element. The fixed element is 55% of the total cost and rest is variable. So if the fixed cost is 55%, so from 580,000, if the fixed cost is 55%, fixed cost, that means the variable cost is 45%, isn't it? What is the requirement? The fixed element of the overhead cost. How much is the fixed element of the overhead cost? Can you give me a figure? How much it is? 580 times 55%. That is 319. Very well done. 319000. So this is our cost for the fixed. The variable element of the overhead. How much is the variable cost we have? 45% of 580,000. That is 261. Very well done. All right, this is not very difficult. So now we move to one of the important questions. That will be our high-low method. Now let's try to understand how the high-low method work. We'll open one question and I try to do a little bit slow so that we can understand. If we don't understand, you can always ask me so that I can explain to you more. So let's try to understand. So high-low method is only used when we have a mixed cost, when we're looking for the total cost, but we don't know how much is the variable cost per unit, and I don't know how much is the total fixed cost. So for that reason, I have to do additional workings to find it out how much is the variable cost and how much is the fixed cost. So let's read this question. We have a S and N. S and N record the following cost for the last 4 months. So 1, 2, 3, and 4. So month 1, month 2, month 3, month 4. The cost is this one and the unit is this one. Okay. Requirement, calculate the cost that should be expected in month 5. when the output is 7,500. The total cost in month 5 when the output is 7,500. So basically they are saying month 1 to 3, 4, they give it to us. They said the cost is this, unit is this, cost is this, unit is this. But they're saying what will happen in the month number 5 if our output or unit is 7,500? How much will be the total cost? So we don't know because we don't have any variable cost per unit. We don't know the fixed cost. We need to do some workings. So let's have a look how we do that. And we called it high-low method. High and low. It's very important to remember this two words, high and low, because our workings will be depends on the high and low. So high and low represent, we look for the higher figure and the higher cost. So higher unit, higher cost, lower unit, lower cost. So from the unit, look at which one is higher. 7, 8, 7, 6. So 8 is the higher. And the cost also, this is higher. And look for the lower. 6 is the lower. And the cost is lower. So now we have a higher and lower both. Very careful the steps, the way I'm doing. So now I'm going to take this one. I said 8,000 unit. The cost is 115. 115,000. And the lower is 6,000 unit. And the cost is 97,000. So now we have a high, low, both cost and the unit. So this is my unit. And this is the cost, the value. The next step, step number 1 is done. Step number 2 is to find the difference between these two. So find the difference between 8 and 6. So it is 2,000. And to find the difference between 115 and 97. Can anyone give me the figure, how much it is? So 115 minus 97,000. That will give us how much? 18,000. Very well done. 18,000. So step number 2, 18,000 we have. We have a unit difference and we have a cost difference. Now I'll take this 2,000 under the 8,000. So we will do 18,000 divided by 2,000 unit. And that will give us the variable cost per unit. So how much it is? 18,000 divided by 2,000. And that gives me 9, not 9,000, should be 9. 9. So this is called variable cost per unit. Variable cost per unit. So first we look for the high and low, we find the difference and divide the cost with the unit. That gives us a variable cost per unit. Now I have the variable cost per unit. Now one step is done, the biggest step. Now can anyone have any questions so far? The steps we are showing so far, anyone have any question? Now we'll move to the next step. So the next step we're going to look at, that is how to find the fixed cost. Now we can take any one. We can take any of the figure. So let's say we take the 8,000 one. So we take 8,000. So 8,000 unit. And the total cost was 115. We can take any figure we like, 8,000, 7,000, 6,000, any one, it will give you the same result. So 8,000, the cost was 115. We take this one. Now, try to understand, for 8,000 unit, total cost is 115,000. For 8,000 unit, total cost is 115,000. So total cost means I have a fixed cost and I have a variable cost, both. Now, if I take out all the variable cost, so the remaining will be fixed cost. So I know the variable cost per unit is 9. So if I take out all the variable cost, the remaining will be the fixed cost. So I said 8,000 unit times by 9. That will give me the total variable cost, because now I know the variable cost per unit is 9. So how much it is? 8,000 times 9, it will give me the total variable cost. How much it is? 72,000. So if I minus the 72,000 variable cost from the total cost, the remaining I have the fixed cost. So how much will be the fixed cost remaining? So we have 43,000. Very well done. So that's my fixed cost. So it's a very simple. So the 9 is come from this one. 2,000 divide 8,000. Have a look. That's how we get the 9. So 18,000 was the difference, and 2,000 was the difference of 8 minus 6. So it will give you 9. So this 9 is the variable cost per unit. All right, so now we have a fixed cost. So now we have a variable cost per unit and we have a fixed cost. So now it is very easy for us to calculate any sort of cost. Now the question said, find out the total cost for 7,500 unit. Very simple. So 7,500 times 9. So it will be my variable cost. How much is the total variable cost? 7,500 times 9. 67,500. Very well done. 67,500. And now I just need to add the fixed cost that I calculated before, 43,000. And that will give me my total cost. That will give me how much? 110,500. So my total cost is 110,500. That's it. Little bit tricky, but not difficult. As long as you understand it, it's not going to be difficult, but it's very much common in the exam. They always tested this thing in the exam. All right, so any question from anyone? Before we move to the next one, we'll do one more question for the high-low method. Any question from anyone for this activity 3, high-low method? Everyone happy with that? Okay, very well done. So let's move to the next one then. The next one we have here, let's do the same thing. Okay, maybe I'll give you 5 minutes to do this one. We'll see how much you can do yourself. So this question said, total electricity cost for 2750 unit. The variable cost is all about, you have to find the high unit and the high cost, low unit, low cost. So you need to find the difference between the high and low, and you need to divide the cost with the unit, and that will give you the variable cost per unit. Try this question, Josina. Hopefully you'll be understand it. So let's take 5 minutes and see if you can do it. So tell me if you have any number, if you have like how much is the cost for the electricity? Total cost. Yes, you have 210. Very well done. Is there anyone have any number for the total cost for the electricity for the month of June? 210, any? Very well done. Shuag, you have 210. So most of you have 210. That means it might be the answer. Hashmi have 210. So it's look like 210 is the right answer. So quickly do that. So let's look at the higher unit first. So from the here, look for the higher unit. So it's look like 3,000 is the higher. So 220 is the higher. And the lower we can see 2100, lower, lower. So let's start with our steps. So 3,000 unit and the cost is 220. Then the lower is 2100 and 184. Then find the difference. So 3,000 minus 2,100, it gave us 900. And here 220 minus 184, that should give us 36. And after that, we have to make a difference. So we need to make a divide. So 900 will go under, 36 divided by 900. And that will give us how much is the variable cost per unit. Variable cost per unit. And that is 4 pence. All right, very well done, Annie. So 0.04, so it is 4 pence. All right. Now we need to look for how much is the fixed cost. We can take anyone, take 3,000. So 3,000, the total cost to us 220. Just take away all the variable cost. So 3,000 times 0.04. If I take out all the variable costs, the remaining will be the fixed cost. So how much it is? 3,000 times 0.04. That gives me 120. Very well done. And the difference will give us the fixed cost. Any remaining from the total cost, it will be my fixed cost. That is 100 pound. That's my fixed cost. How did you get 0.4? Sabira, you need to look at when I do. So we have a 900 here, and the 900 is divided by 36. So 36 divided 900, you can see it here. 36 divided 900, it will give you 0.4. All right, so then we have to calculate for the 2,700 unit. Is very simple. So 27,500 times by 0.04, and that will give us my total variable costs. So how much it is? 2750 times 0.04. That will give us 110. So 110 is the variable cost, and the fixed cost I already have, that is 100. So fixed cost will be plus 100, and that will give us 210 total cost. So that's my 210. All right, so any question from this one, from anyone, to understand how to calculate that, because it's going to be very much common in the exam, your high-low method, so you need to make sure you understand how to do it. Anyone have any question from this one? We can explain again if you need an explanation before we move to the next one. Everyone happy with that? All right, very well done. Let's move to the next one. The next one we have here, and that is activity 5. Let's have a look at this one. Changing the activity level. Changing the activity level means what happens if the unit is changing. For example, if I make 1,000 unit, if I make 2,000 unit, if I make 3,000 unit. So what happens if the activity means like number of unit. Requirement, if activity level increase, what will be the impact on the following cost per unit? So you have a cost. The first one you have is stay same, increase and decrease. Stay same, increase and decrease. Okay, so variable cost per unit. So the first one they said, what will be, read the question once again, if the activity level increase? If the activity level increase, that means if I make more unit. If the activity level increase, if I make more unit, what will be the impact on the following cost? So what will be the impact on the following cost if I make more unit? Variable cost per unit is stay same, increase or decrease? What do you think? Variable cost per unit, stay same, increase or decrease? Remember that variable cost stay same. Why? For example, if I make 1 unit, let's say variable cost per unit is £5. So it will be £5. If I make 2 units, so 2 times 5. If I make 3 units, is 3 times 5. So variable cost per unit remains same. So it will not increase, not decrease. It's at per unit. Remember the cost per unit, not in total. Not in total, per unit. So per unit, the variable cost remains same. Remember that. Per unit, the variable cost remain same. So it says stay same. It doesn't matter how many units I make, my variable cost per unit remains same. If I make more units, the total cost will be increased, but not per unit. Fixed cost per unit, it will be stay same, increase or decrease. Fixed cost per unit. Fixed cost per unit will be decrease. Fixed cost per unit will be decreased. Very well done. Semi-variable cost per unit. Semi-variable cost per unit. Semi-variable means we have a fixed cost and we have a variable cost, both. So what will happen? It will be stay same, increase or decrease. Semi-variable cost also decrease. Why? Because inside of the semi-variable cost, we have a fixed cost as well. So if the fixed cost is decreased, that means the total semi-variable cost also decrease. Then we have a total cost per unit. So if I make more unit, total cost per unit will be increase or decrease. Total cost per unit will be also decrease. Very well done. Very well done. Because if I make more unit, my fixed cost will reduce. And if the fixed cost is reduced, my total cost also reduce. Remember that there will be no changes of the variable cost, because variable cost is fixed per unit. Only the fixed cost will decrease. And if the fixed cost is decreased or reduced, then my total cost also going down. All right, so let's move to the next one. The next one we have here, changing the activity level. So let's have a look at that. Revenue, cost, and profit. Identify whether the following statement are true or false. The first one is says, as the level of output decrease, the amount of revenue per unit will decrease. What do you think? Is it true or false? Level of output decrease. If I make less unit, revenue per unit will decrease. So per unit revenue will be decreased as well. True or false? Try to understand the question very well, then you give the answer. You can see true and false. Try to understand per unit. Let's say if I sell 1,000 unit and the per unit is 10 pound. So let's say it is 10,000. Now if I now only sell 100 unit, 100 times 10, it will be 1,000. So it is decreasing in total, but per unit 10 pound is same. So if I make less unit or if I sell less unit, it doesn't mean per unit will be decreased. So for example, if I sell 1 pen 10 pound, that means if I sell 2 pen is 20 pounds. So per unit 10 pound is fixed. If I sell more unit, I have a more total, but per unit is not changing. Per unit is not decreasing because I'm selling 1 unit is 10 pounds. So if I can sell more, it will be 10, 10, 10, 10, but the 10 will not be reduced. So it is false. Then as the level of output decrease, if the total unit decrease, the fixed cost per unit is stay same. True or false? If I make more unit, the fixed cost remains same. True or false? So we know it is false. Because if I make more unit, remember, if I make more unit, my fixed cost per unit will be less. For example, I gave the example before. Let's say if my rent is 10,000 pound. If my rent is 10,000, if I produce 5,000 unit, for example, if I produce 5,000 unit, then the fixed cost per unit will be 2. And if my rent is 10,000, if I can make 10,000 unit, then fixed cost per unit will be 1. That means if I can make more unit from 5 to 10,000, then fixed cost per unit will go down. So it will not stay same. Very careful. The variable cost is stay same per unit. But the fixed cost, if I can make more unit, the fixed cost will be reduced. Fixed cost is fixed in total. Total is 10,000. But if I can make more unit, the fixed cost per unit will go down. It is also false. The next one is says, as the level of output increase, the amount of profit per unit will increase. So if I make more unit, the profit per unit will increase. True or false? That's true, isn't it? If I sell, obviously, if I can make more unit, my fixed cost per unit will be reduced. And if the fixed cost is reduced, my profit will be more. In the cost, I have two types of cost. I have a variable cost and fixed cost. So if I make more unit, so fixed cost per unit will go down. So if one of the costs going down, so my profit will go up. So it will be true. All right, so any question from anyone from this activity 6? Anyone have any confusion? Everyone happy with that? Very well done. So let's move to the next one then. So this is the end of the chapter. So we'll move to, okay, can explain third one. Yes, sure, like I can. The third one is says, as the level of output increase, the amount of total cost per unit increase. It says, if I make more unit, my total cost also will be increased. That's not true, isn't it? Because if my output is increased, then what will happen? My fixed cost per unit will decrease. So if the fixed cost is going down, so the total cost also going down. It will not increase, so it is false. All right, so let's move to the next one. The next one is the end of the chapter number 2. We move to chapter number 3. So before you start chapter number 3, we'll take a break. So let's take a 25-minute break. We'll come back 8 o'clock and we'll start from chapter number 3. So I'll see you in 25-minute times. 8 o'clock we'll start. So chapter number 3 we have, that is the material and the labor cost. So here we're going to do some workings and we're going to see how the labor cost work and how we record the material also in different level, how to control the inventory also going to look at from this chapter. So let's have a look at the chapter overview, what we have in this chapter. Let's have a look at that. So material and the labor costs. So first thing we can see here, we have categories of material. Categories of materials. We have a different types of material. We can see the raw material. So raw material is basically the material that we buy in order to use it in the work in progress and to make the finished good. So for example, if I like to make some bread, so the flour will be my raw material. Work in progress. Work in progress is all about like when the raw material is on the process. So for example, if I need to make some bread on the machine, I put some sugar, I put some eggs, I put some flour, so it mix it up. So when it mix it up in the machine, that is called work in progress. So the things is not done yet, is still work in progress. Then we have a finished goods. Finished good is a ready to sell. So that one can be on the closing stock or on the inventory because it's ready to sell. Then we have a buying material. So how do you buy the material? It's a purchase requisition. So before we buy the material, we have to raise the requisition. The requisition normally raised by the production department because they knows how many quantity or how much quantity they need for which material. So they raise the requisition to the purchase department and purchase department make the order for them. Then the purchase department make the order and good receipt note, GRN, good receipt note, like when you receive the product. So this is a confirmation that you received the product. This is called good receipt note. The next one, we have a control of the inventory. How we can control the inventory? We have a locating the inventory. So the inventory is recorded on the inventory record card, or sometimes you call it bin card, more or less the same thing. So where we record the inventory, how many inventory we have, how many issue, how much is left, all of this. Issuing the material requisition note, material return note, and material transfer note. Levels. So levels is like kind of depends on the organization policy, but it is not very important for your exam. It will never come in the exam, but for your understanding, you can read that. Basically, the levels is all about how much or how much is the level I have to keep in order to order again for the material. For example, let's say some company can decide like I need to make sure like we have enough stock. So for example, when we have 100 unit in the stock, as soon as it's reached to 100, I have to make the order. One company can say, no, I have to make sure I have 500 unit. So as soon as it is come down to 500 unit or the stock, I have to make the reorder. Some company can say, no, I will just only keep 50 unit on the stock. And once it is reached to 50 unit, I need to make the reorder, the material. So it depends on the company, how much you like to keep this stock and when you like to make the reorder. So we have some formula, the reorder level, maximum inventory level, and minimum inventory level. This formula you can memorize, but it will not be in the exam. It's not very important. But for your understanding, you can always read that. The next one, we have inventory valuation. This is the common one. Inventory valuation, how we value the inventory. For example, let's say we make, for example, 10 unit or 100 unit, and we're able to sell only 80 unit. So whatever is the 20 left on the stock, now how much will be the value of the stock? This is the thing we need to see and how we value that. Now when you buy the inventory or stock or the raw material, for example, we have to use some technique. So before we issue it, so when you issue, we have to use some technique. What is the value we're going to use? Now it is possible, for example, every time we buy raw material, we pay different price. For example, in the year of January, we buy 10 kilo sugar. We paid, for example, £1 per kilo. But in the month of March, when you order sugar, maybe it is £1.20 per kilo. So obviously, like every time when you make the order, the price is not same, and normally the price is always increased. So the material we buy earlier is a little bit cheaper, but the most recent material we buy, it most likely it is more expensive. Now, the way we value the inventory when you issue the inventory, the material, so we use the FIFO. The FIFO means first in, first out. First in, first out represent like when we buy something, for example, at the beginning of the month or maybe at the earliest period, we have to sell this one first. We have to issue this one first. So which one I buy first, I'll make sell this one first, then we'll go to the most recent one. So for example, if I buy some raw material on January and February and March. So first I need to make sure I use all the material I use in January, then I move to the March one. So I use all the March first, February, then I use all from the March. So basically, which one I buy first, I have to use this one first. So first in, first out. Which one came to the warehouse first? This one need to go first from the warehouse. Then we have a FIFO. FIFO is all about average. FIFO is all about the average. Now this is quite straightforward. Before we issue the inventory, we need to make the average. Average means how much is the cost and how many units. So cost divide unit, it will give us the average. Then we have a time-based labor hour system. Here, how we pay to our labor. How we pay to our labor, we're going to see this from there. So normally the labor have a paid per hourly basis. So how many hours they work, we paid based on the number of hours. Sometimes they get overtime, and obviously the overtime is normally higher than the normal rate. For example, if the basic rate, let's say the basic rate is a £10 per hour. Let's say the basic rate is £10 per hour. And over time, if the question said time and half, time and half. Time and half means one, you have to multiply by 1.5. So 10 times 1.5. That means the overtime rate will be 15. So time and half means 1.5 we have to multiply with, and that will give us how much is the overtime rate. Now, one thing I want all of you to remember is very important. Overtime and the overtime premium is not the same thing. Overtime and the overtime premium is not the same thing. Overtime means, for example, if I work 1 hour overtime, that means, for example, I get £15. But how much is the premium? Premium means the extra. So how much I'm getting normally, for example, I was getting normally £10. That means £10 is not the extra. How much is the extra? Actually £5. Because £10 I'll get anyway. If I work anytime, 1 hour, I get £10. So if I work overtime, I get £5 extra. So this £5 we call premium, overtime premium. Some students, they got confused in the exam. So you need to make sure like overtime and the overtime premium is not the same thing. So you need to read the question very carefully, because if the question asks you how much is the overtime premium, you don't write the whole amount. Overtime premium is the difference between the overtime and the basic rate. How much you're getting extra because you're working overtime. This is called overtime premium. All right, then overtime hourly rates. So overtime premium for the more than hours, so we understand that unless it's specific. Normally, the labor hour, direct labor hour is the direct cost or the prime cost, obviously, unless obviously like it is a request for a specific job. Now, indirect cost, for example, as we know, indirect cost obviously is our overhead, and normally the indirect cost we treat it as a overhead cost unless it is a specific order. For example, if we make this pen and we make a lot of pen together, then anytime if we spend something for the overtime, that will be my indirect cost. But if the job is for only one specific order, for example, let's say if you are making a house, or if you're making a customized car. For example, one customer said, can you make the car like that? So it's customized. It's not a very general or common for everyone. It is customized. If this is the case, even if you spend overtime, that will be treated as a direct cost. So you need to remember that if you do a specific order or a specific work, then the overtime will be treated as a direct cost. Other than normally, the overtime always indirect cost. Now, overtime premium is the difference how much you're getting normally and how much you're getting extra because you're doing overtime. So as I said, have a look, Jin. So normally, for example, if you work 1 hour, you get 10 pounds. For example, it is your basic hour. If you work 1 hour, you get 10 pounds. But one day you work 1 hour overtime. And overtime is times and half, because normally overtime payment is more than the normal hour. So let's say this overtime is times and half. So if your rate is 10 pounds, the overtime is 15 pounds for 1 hour. Now, is the 15 pound you're getting extra? No, you're getting overtime for 1 hour, you're getting 15. But if it is not overtime, you get minimum 10. So how much you're getting extra? The premium. So the premium is the difference between the overtime and the basic rate. So how much you're getting extra here? 5 pound. So 5 pound is the overtime premium. All right. Okay, so let's move to the next one. The next one, we have a model EOQ. We're going to look at this one. It's very important. So EOQ represent economic order quantity. Economic order quantity. Economic order quantity means, for example, if you work for a company and you are not sure like how many material you have to order or when you have to order. For example, if I'm just joining one company as a purchase manager and I have no idea when should I order. So for example, if your manager asks you what quantity will be better for us to order, shall we order 2,000 units? Shall I order 5,000 units? Shall I order 10,000 units? So what will be the best combination to order every time? So to get the answer for that, we have to use this EOQ model. EOQ is called economic order quantity model. Now the formula here we have to remember. In the top we have 2. 2 comes from the formula. Then we have to multiply with CO. CO represent cost of ordering. CO represent cost of ordering or ordering cost. Cost of ordering. CO represent cost of ordering. Then we have a D. D represent demand. D represent annual demand. Annual demand. Remember that in the exam, if the question give it to demand for 1 month, we have to multiply by 12 because you always look for the demand for the whole year. Very, very careful. The demand will be for the whole year. In the exam, if they give you the demand for 1 month, we have to multiply by 12. Then you have to use the root over. Root over is basically from the formula. On the bottom, we have CH. CH represent cost of holding. Holding cost means if I keep the stock in the warehouse, how much will be the storage cost? So holding cost or the storage cost is the same thing. So this is the formula, and how much unit will come, that will be my best number to order every time. All right, so we're going to look at this question anyway. So let's move on. So we have here this thing you can read yourself, but it's not very important. So just quickly have a look this one. How is the annual demand calculated? So annual demand base means yearly demand. So for example, if the question give you the yearly demand is 1000 unit, so we understand it is yearly demand. But if the question said the monthly demand is 100 unit, that means it's not yearly, isn't it? So we need to multiply by 12 to find it out how much is the yearly. So for example, 120. So we need to find it out how much is the yearly demand. It will be given exactly. What was the two signifying again, please? Which one it was, Jack? So if you tell me which one you mean that. Okay, so let's have a look this one. The double entry. Try to understand this double entry. The EOQ, yeah. The EOQ is the economic order quantity. So on the top, we have the CO, that is the cost of ordering, and times by D. D is a demand for the whole year. And under, we will have CH, that is cost of ordering or cost of holding or the storage cost. We do one question, you will understand maybe more detail when you do the question. So hopefully it'll be fine. So don't worry too much. Yeah, the 2 is come from the formula. So it's nothing like, there's nothing to understand. 2 is from the formula. All right, so let's have a look this one. This is the double entry. I try to understand, even it will not come in the exam, just try to understand how does it work. Now, when we have buy something, what will happen? First, we buy something, we record in the form of journal, and after that is move on. And finally, this information we can record on the financial statement. That means either on the profit and loss account or on the balance sheet that we submit to HMRC, isn't it? So here, have a look. When you buy a material, so let's have a look. The relevant double entry for a single purchase of material. So purchase of raw material. So when you buy a raw material, what happened? Either I can pay for that cash or I can buy on credit. So if I buy a material, I said inventory is debit, or maybe the materials is debit, and the cash is credit or payable is credit. If I pay for that immediately, then cash is credit. If I pay later, then payable is credit. We know this one is a very simple thing. So purchase of raw material, so material is debit and cash or payable is credit. Then after we buying this, what will happen? We keep this one in the warehouse. So we buy the material, keep on the warehouse. And what we do next? We use this material or the raw material for the production. So we take from the inventory and use it on the production. So for that reason, we said production will be debit or direct cost will be debit and inventory will be credit. You can see here, before the inventory was debit, now the inventory is credit. Where this one has to go, because now there is no more inventory because all the inventory I use in the production. So production is debit, inventory is gone, inventory is credit. Before the inventory was debit, so debit and credit like a plus and minus, it will be gone. Then next step is what we do. This production will be finished one day, and from the production, the finished good will come. So it will be start processing, and the finished good, the complete unit will come. So in the finished good will come, so finished good will be debit, and this production will be credit because production will be gone. There is no more production because it will come as a finished good. Being the transfer of unit that are now finished to the finished good inventory. So after the finished good, when it is complete, ready to sell, this one will be part of our cost of sales. When it is ready to sell, this will be our part of cost of sales. So the cost of sales will be debit and the finished good will be credit. So finished good is gone and the new inventory will be on the cost of sales. And from the cost of sales, finally, it will go to the profit and loss account. So it will go to the profit and loss account. So profit and loss account debit and cost of sales credit. So this is steps. You start from the purchase and end up with the statement of profit and loss account. There are few steps involved here. So one go from one and the next one will be created. The journal is very important even for your workplace. If your journal is not good, you'll find difficult on your workplace. So you need to make sure your journal is good. Now there are a few things here who not very important. We'll skip few things, but I will do the important thing for this paper and the exam. What is the cost of sales? Okay, the cost of sales, Shuleka, is the direct cost. The formula for the cost of sales, cost of sales. You have to remember what is cost of sales. Cost of sales means all the costs and that is relevant to the product, the direct cost. So it represents opening inventory plus purchase less closing inventory. So opening inventory plus purchase less closing inventory is equal cost of sales. And the cost of sales is the direct cost. We minus it from the sales or revenue to find out the gross profit. All right, let's look at one activity we have, holding the inventory. Let's try this one. It says, which of the following are reason for holding inventory? So what is the reason we keep some stock on our warehouse? What is the reason behind? Tick all those that are valid reason. Let's read one by one. So let's read the first one. To avoid production stoppage due to shortage of material. Do you think it could be the reason? That's why I keep some stock. Maybe the production will be stopped and will be shortage of our material. So the answer is yes. For that reason, I can hold the inventory in my stock. The next one is says to take advantage of quantity discount. I like to take a quantity discount because I buy a lot at the same time, because if I buy more, they give me a discount. For that reason, I buy a lot so I can keep in the my warehouse. Do you think it is a valid reason? Let's say it could be like a possible valid reason. It's not like, do you think like if someone can do that? The answer is yes, isn't it? Some people can buy a lot because they got some quantity discount. They buy a lot at the same time, they got the bulk discount. For that reason, they can buy a lot and keep on the warehouse. Yes, that could be the possible reason. The next one we have avoid detrimental effect of price fluctuation. So it is possible the price will go up in future, and for that reason, I buy more and keep on the warehouse. Do you think it could be the valid reason? Answer is yes. Is the valid reason. The next one we have here, to provide a buffer or fail safe in time of general shortage or heavy demand. So for the shortage of heavy demand, so we understand maybe suddenly the heavy demand will come or there will be shortage. So I want to buy more so that I can keep on the warehouse. So this could be the valid reason as well. Yeah, so all these things could be the valid reason I buy more stock and keep on the warehouse. All right, let's move on. So the next one we have here some formula. You can read this, but it's not very common in the exam. It will never come, but we can do one question to just show how does it work. So for example, the first formula we have here, maximum inventory level. Maximum inventory level is the inventory buffer plus maximum reorder quantity. And then reorder level. Reorder level means average users times average lead time plus inventory buffer. Inventory buffer or buffer stock is called sometimes safety stock. For example, if you have a car, there is some reserve oil you have, even the oil is finished, then you can still use little bit, so you have some reserve. So the buffer means like even the stock is finished, there are something safety stock you have, so we called it buffer stock. And then we have a reorder quantity. Reorder quantity, we have at the reorder level, more inventory is ordered, the quantity is ordered depend on whether the management want to order enough to restore inventory to maximize maximum level of minimum level. So minimum order quantity, average uses, average lead time, maximum order quantity, maximum inventory minus inventory buffer. Now, as I said, it's just like the formula. It's not something is understanding anything. So you can try this question. Let's try this one, but it is not very common for your exam. Inventory control level. A large retailer with a multiple outlet maintain a central warehouse from which the outlet was supplied. The following information is available for the part number CV 2005. So we have average uses, average minimum uses, maximum inventory level, lead time, and we have inventory buffer. So let's try the first one. The first one says, what is the reorder level? The reorder level, the formula is average uses times average lead time, then plus buffer inventory. We don't have any buffer inventory anyway, so average uses, have a look. The average uses we have 350, so 350 times average lead time. The lead time is says 11 to 15 days, so you need to make it average. So 11 plus 15 divided by 2, that will give us the average lead time, that is 13 days. So times by 13, and there is no buffer stock in this question. So all you have to do, 350 times 13. Oh, we have a buffer, isn't it? We have a 1750. Sorry, we have a buffer here. I didn't see that. So we have a buffer is 1750. So we do this times this plus 1750. So that will tell us how much is the reorder level. Is 6300. 6300. The next one is what is the minimum inventory reorder quantity? So minimum inventory order quantity, you can see the formula, minimum order quantity. So average uses, average lead time. So average uses, average lead time. So how much is the average uses? 350. And average lead time is 13. So we know this one. So 350 times 13. How much it is? 4550. 4550. Then we have what is the maximum inventory quantity? Maximum inventory quantity, this one, maximum reorder inventory quantity. That is a maximum inventory level minus buffer inventory. So maximum inventory level, we have 10,280. 10,280 minus the buffer is 1750. And that will give us the maximum inventory quantity. And that is how much? 9070. And this is just the formula you have to use. There is nothing to understand. And this will be not very much common in the exam. It never come in the exam. All right, so let's have a look. The next one, the EOQ is quite common in the exam, so we need to understand how does it work. So let's try this one, EOQ, economic order quantity. So what is the EOQ unit? So we have to see how can we find it out, how much is the EOQ. So I need to first know the formula. This is our formula. So on the top is a 2CO times D. In the bottom, CH, cost of holding. Let's try that. So 2 is from the formula We have to use the root. And CO, cost of ordering. Let's read this question. It says the demand for a product 150 unit per month. You see that? The demand is 150 per month, but the formula always says we have to find the demand for the whole year. So you have to multiply by 12, 150 times 12. Because we need to find the yearly demand. Remember that. That will give us the yearly demand. Then we have, it says it costs 25 per unit to purchase the product. So purchase cost is 25 pound. The fixed cost per order 32. So the ordering cost is 32. So CO is 32. CO is 32. Cost of ordering is 32. The holding cost is 18% of the purchase cost. So that means 18% of the 25. How much it is? So cost of holding is 18% of the purchase cost. So purchase cost is 25 times 18%. How much it is? So 25 times 18%, that will give us how much is the purchase cost. So we do 25 times 18%, that gives me 4.5. So 4.5 is my holding cost, the cost of holding, yeah. Now we have to follow the formula. Let's do the formula. So 2 times CO, cost of ordering, that is 32. And the demand, how much is the demand? 150 times 12, how much it is? 150 times 12, that will give you the demand for whole year, 1800. Very well done, Rita. So we have like 1800 for the demand for whole year, so 1800. And on the bottom, we have the cost of holding, that is 4.5. And after that, we do the root over. Can anyone find the figure, how much it is? So you do 2 times 32 times 1800 divide 4.5, then do the root over. Make sure you have a calculator on your, you have a root on your calculator. Otherwise, it's going to be difficult for you to calculate that. How much it is? 160. Very well done. So 160. So I need to order 160 unit. Based on the situation, I have to order 160. This is the best combination for me to make the order. All right, let's move to the next one. Any question from anyone before we move to the next one? Anyone have any question from this one, from EOQ? All right, very well done. Let's move to the next one. We have a FIFO and FIFO. Let's try that. You have to ask me which one you want me to explain. So it's a very simple, as I said, like you need to use the formula. Which one you didn't understand? You can see here, just all you need to use the formula. So you have a 2 times COD, that is CO represent the cost of ordering, that is 32 in the question, they give it to us. Then the demand we multiply 150 times 12, 1800. CH is the cost of holding, that is 18% of the purchase cost. The question said 18% of the purchase cost is 4.5. So 2 times 32 times 1800 divide by 4.5 and the root over that gives you 160. Is that clear? 160 is the unit you have to order. All right, so let's move to our valuation method. So the valuation method we have here, FIFO and FIFO. So let's try to do that. So have some example, but we'll go to the question. We'll do it there. Okay. Let's read this one, activity 6. So as I said, like FIFO represent first in, first out. So we need to issue the unit that we receive first. So anything came first, you have to go first. So if I receive the material earlier, so I have to make sure I issue this one first before I move to the next one. Let's read this question and let's try to understand it. So it says the demand for a product is 150 per month. So it could be any product. the demand for a product, 150 units per month. It could be any product. Then CCS is a new business that has only been established since March 2009. So they established March 2009. The company makes a small range of specialized organic soup that is sold to supermarkets and independent retailers. So they sell organic soup to the retailer and the supermarket. Prices of all the ingredients that the company has to buy are increasing. Very, very important. This is a very important clue. So the ingredients, the raw materials maybe we buy for the soup, like eggs or anything, the price is going every day. So what indication we have from here? So that means whatever I buy earlier, before, the price is less. Anything I'm buying now, the price is more, because the question says is increasing. The price is increasing every day. Bearing this in mind, CCS would like to use the inventory issue and valuation method that would give it the highest reported profit in the first year of the trading. So they like to use a method. That method will give them higher profit at first year. So they're looking for a method, FIFO, FCO, which method, any method they like to use that will give them the higher profit at first year. So let's try to understand what does that mean. Now, before we start this portion, I want you to show the cost of sales formula once again. Now, how we calculate the profit? Let's try to understand. So first we look for the sales. Sales means the income. So from the sales, what we do, we minus the cost of sales, less cost of sales. It's very important, very careful to understand this. So from the sales, we minus the cost of sales to find it out, the gross profit. And the cost of sales have a formula, that is opening inventory, and then plus purchase and less closing inventory. And that will give us the cost of sales. Now let's try to imagine any amount. Let's say, for example, my sales is 1,000, for example, and my opening inventory is 100. My purchase is 200. And let's say my closing inventory is 50. We minus that. So opening inventory plus purchase, so 200 plus 100 plus 200 is 300. From 300, we minus the 50, and that gives me 250. So my cost of sales is 250. And we have a gross profit here. So, and this cost of sales, if we minus from the sales, that will give us the gross profit. So 1,000 minus 250, that will give us 750. So this is the profit. Try to understand it. If my sales is 1,000, if my opening inventory is 100 and purchase 200, and the closing inventory is 50, then my gross profit is 750. The question said, use a formula that will give us higher profit. Now, try to understand. On the stock, we are valuing the inventory. Remember that when I said the inventory, we always mean the closing inventory. Inventory means the closing inventory, because whatever is closing for this year is the opening for next year. Anything is closing for this period is opening for next period. Now that means all the thing question mark with this one, the closing inventory. Now let's try to understand. So if I increase my closing inventory figure, let's say from 50, I make it 100. So if my closing inventory is more, let's have a look how much is the profit. So I minus 100 plus 200, 300. So minus 100, it gives me 200. So if my cost of sales is 200, that means my gross profit will be now 800. So what we understand from here, we understand if the closing inventory goes up, my profit is going up, because closing inventory we minus from the total cost, and obviously closing inventory reduce our cost, because closing inventory minus from the cost of sales. So if I minus the closing inventory from cost of sales, that means my total cost will be reduced. If the total cost is reduced, my profit will go up. So far, this is our concept. Is very important to understand. So now our point is, somehow we need to increase our closing inventory. If I can increase my closing inventory, my profit will go up. Why? We already explained that. Now, which method can increase my closing inventory? Now let's try to understand that. For example, I have January, February, and March. Let's say I buy the raw material in January in the price of 10, February per kilo 12, and March per kilo 14, for example, because the question said every day it is increasing. So the raw material price is increasing every day. So if it is increasing every day, now according to the FIFO method, I have to use my January 1st and February 1st. Then anything I have left over, it will be on the stock. That means if I use the FIFO, so whatever I have in the stock, that will be the most recent one, because anything earliest one that I have to be used first. So most recent one will be in the stock. And if the most recent one in the stock, that will be more valuable. So the closing inventory will be more value there. So it will be more value for the closing inventory. And if it is give us the more value for the closing inventory, that means my profit will be higher, because more closing inventory means more gross profit. So that means if I use the FIFO, first in, first out, that means my profit will be higher, because I have to use all the old inventory first and all the new inventory first in, first out. So all the first in will be gone. So which one I buy recently, it will be on my stock, and this one will be more expensive because I buy recently. And for that reason, my cost of closing inventory will be more. And if the closing inventory is more, then I will have a higher profit. So do you understand this one? It's a very tricky thing, but this is the whole concept you need to understand. All right. So we're going to write here, identify the method that would be achieve this. So which method will be help us to get the profit more in the first year? We said FIFO, first in, first out. All right, let's move to the next one. The next one, they're asking to calculate the closing inventory. Let's try this one. Let's try to understand. Use the method identified in A. So in A, we identified FIFO. So you understand that. In A, we have identified FIFO. So let's try to do this. So you can see the date. Date is very important. 1st June, 2nd June, 3rd June, 4th June, 5th June. Then we can see here receipt, issue, and the balance. So you can see at the beginning of the June balance, we had 72 unit and the value was 10,512. Then on 2nd of June, we buy another 70 unit. So 70 plus, we already have 72 before, so it become 142. And for the 72, the cost was 10,512 before. Now the new cost is 70 times 150 is 10,500. So 10,500 plus 512, it gives me 2112. On 3rd of June, we issue 90 unit. Now the question is, which unit I'm going to use first? Who can tell me? Which unit I'm going to use first for the 90 unit? So I'm going to use first in, first out. So for this 90 unit I need, I'm going to use all the 72 first. And this 72 gave me a cost 10,512. I still need some unit. How many unit I need more? So 90 minus 72, I need still 18 unit. And this 18 unit I'm going to take from where? From this 70. So from this 70, I'll take this 18. So I say 18 times, how much will be the per unit? 150. So 150. So how much will be total here? 18 times 150. Can anyone tell me how much it will be? 2,700. 2,700. So this 2,700 I'm going to add with that. So 27 plus 10,500, that will be the cost for 90 units. So how much it will be total? 13,212, 13,212. Okay, so let's do this one now. So I want to issue the 90 units. So I said 72 units I'll take from there, and I need another 18 I'll take from here. And the total cost will be 13,212. So how much will be the balance now? If the 90 is gone from 142, how much will be the new balance? So 142 minus 90. So it will be left 52 unit. And how much will be the cost from 21,000? If 13,212 is gone, how much will be the new balance for the cost? 7,800. 7,800. Very good. Now we can see on 4th of June, we buy some more receipt. So we buy another 50 unit, and each unit is 152. So how much it is? 50 times 152. How much is the total cost for 50 unit? 7,600. Very well done. 7,600. Now how much will be the new balance now? 52, and we buy now 50. How many unit we have now? 102. And how much will be the cost? 7,800 we have before. Now we have 7,600. So 7,800 plus 7,600, 15,400. 15,400. And finally, on 5th of June, we can see we issue 70 unit. Now tell me, from where are we going to use 70? So from this 72 is already finished. And from this 70, I already use 18, isn't it? So from 70, 18 is already gone. So how many unit I need to use from here? So I need 70 unit now. So I'll take 52 from here. So I said I need total 70 unit. So I'll take 52. And the cost for the 52 was 150 each. So we need to take that, and we need more 18. And this 18 I'll take from this 50. So 18 times 152. So 50 times 150. Sorry, 52 times 150, how much it is? So 52 times 150, that gives me 7,800. And 18 times 152, how much it is? 18 times 152, that is 2736. Thank you very much. And if we added this two, that will be the cost for the 70 unit. How much it is total? 10,536. Thank you very much. So we said we take 52 and 18. The total cost is 10,536. And if you minus the 10,536 from this 15,900, how much will be the balance? How much will be the balance for this unit? 4864. 4864. And how many unit will be the balance? From 102 we minus 70. 102 we had before, we minus the 70 is 32. Very good. So you can see the closing inventory. How much is the closing inventory we have now? So the closing inventory on 5th of June, we have 32 unit, and the cost for the 32 unit is 4864. All right, so any question from this one, from anyone? Anyone have any question from the FIFO? All right, very good. Let's move to the next one then. The next one we have here, work in progress. Now let's try to understand what is work in progress and what is equivalent unit. So we have something called equivalent unit. Read this one. Equivalent units are the number of complete unit to which the work in progress is equivalent. So it is the equivalent to the number of completed unit. For example, let's say we make a bread. For example, this is a bread, and this is let's say 50% complete. And we have another bread. This is also 50% complete. So if I have a two bread and both are 50% complete, can I say it is equal to one bread, one complete bread? So when two bread is half complete, 50%, 50%, so I can say it is equal to one complete bread. So this is called equivalent unit. So how many unit I have? That is, some unit is on the work in progress, like on the machine, and some of the product is 50% complete, some of the product is 40% complete, some is 30% complete. So we need to see if we make it equivalent, how much it is equal to the complete unit. So how many unit we have that is equivalent to the complete units? So for example, if I have 1000 unit, and if all the 1000 unit is 50% complete, then I can say it is equivalent to 500 complete unit. This is basically the equivalent unit. Okay, we have one example here. So let's try this question. We have activity 7. Let's try that. Closing work in progress. Production cost for June included direct material 30,000, direct labor 20,000, and production overhead 10,000. At the end of the month, 3,460 units were completed, and 900 unit is 60% complete. So 900 unit is only 60% complete. So it is not completed 900, so we cannot take all the 900. It is 60% complete. We can multiply that to find it out how much it is equal to the equivalent unit. So 900 times 60%, how much it is? 540. So it is equivalent to 540 completed unit. So 900 unit, if it is 60% complete, that means it is equal to 540 completed unit, because we need to find the value. So we cannot make the value of the half unit. That's why we have to equivalent it to find it out how much is the value of the completed this unit. Okay, let's try to do this question. Calculate the cost per equivalent unit. So we cost per equivalent unit. So let's find out how much is the cost total. So the total cost we have, so 30,000 is for the material. Then we have labor 20,000. and we have the overhead 10,000. So the total cost is 60,000. So no problem for that. Total cost is 60,000. And the equivalent unit, I already have 3460. This is completed. So 3460 is completed. And we have equivalent unit 540. So equivalent unit 540. So plus 540. So how much is the cost per equivalent unit? So you can see here 60,000, and on the bottom we have 3460 completed, and 540 is kind of equivalent. That will be equal to the complete unit. So how much will be the cost per equivalent unit? You find it out. Tell me how much is the figure. 15. So 15 per equivalent unit. Okay. So 15 per equivalent unit. Very good. The next one is says calculate the closing value of the work in progress. Closing value. So closing value of the work in progress. That means how many units we have on the process. This is not completed yet because it will be on the stock. So closing value of work in progress. It is still on the process. So it's at 540 we have, and per unit is 15. 540 we have, and 5 per unit is 15. So it will be equal to how much? 540 times 15, and it will give you 8,100. So the value of the work in progress is 8,100. So we have some unit on the machine. We have some product on the machine, and the value of this is 8,100. Work in progress, that means it's not completed yet. And the reason we take 540, not 900, because 900 is not fully completed. So we have to find the equivalent and multiply the per unit to find it out how much is the value for that. All right, so any question from this one from anyone? All right, very well done. So if you don't have any questions, so we can stop here today. Next week, we can start from our labor section from the next question, and we can keep going on. So hopefully, like, we have done quite enough today. So all you have to do, you have to practice what we have done. And as I said, like, you can watch this video again if you want to watch, but obviously you need to practice a lot. Make sure you start your revising from now so that like you don't get behind, because if you start revising from now, and then obviously by the time we'll finish our lesson, you'll be ready for the exam. So you need to make sure you keep revising. If you have any question, keep a note for that. You can ask me next week on the lesson time, and I'll be able to explain to you. So make sure you start your revising, and hopefully we'll start from here next week.